Hi everyone, welcome to our quarterly Mortgage Trend Series webinar. You might notice that the layout looks a bit different from what you're used to. We're excited to introduce you to our new webinar platform. This platform is more interactive and customizable for each attendee. You can personalize your view by moving, resizing, or hiding different elements on the screen. Simply use the corners of the icons to adjust the size or positions of the boxes. We encourage you to engage with us using the interactive tools on your dashboard. If you have any questions throughout, please submit them using the questions box on the lower right-hand corner of your dashboard. We will do our best to address your questions in real time. You will also notice a survey on your dashboard. Please fill this out anytime during the presentation. To let us know your thoughts throughout the presentation, use the emojis. To access the emojis, click the smiley face on the right side of your lower banner. Your feedback is valuable to us, and it is used to craft future webinars. For those of you seeking CPE credit, you will need to answer all 4 poll questions during the webinar. CPE certificates will be sent out via email within a couple of weeks. Lastly, this session is being recorded. We will send out a link to the recording within a couple of days so you can revisit any part of the presentation. If you would like a copy of the slide deck, you can download it from the left side of your screen at any time. Now that we've covered all of the details, I'll turn it over to today's host, Nathan Lee.
Thank you, Gabby. Sorry, it took me a second to come off of mute. I'm getting used to the new format as well, but welcome everybody, and thanks for joining us for this quarterly trend series webinar. It's always good to get together with you and share some of the insights that we see as we're working with clients. We have a lot of data to present today, and we're excited to get into it with you. I had planned to start talking a little bit about what's going on in the economy, but I just don't even know that I want to take a stab at that right now. It's virtually impossible. I think everybody on this call would say the same thing. There's certainly a lot going on, and I don't want to hold myself out as an economist, but I will say that a lot is happening, and there is a significant amount of uncertainty in terms of what it's going to mean for housing, what it's going to mean for interest rates, and therefore what it will mean for loan origination volume and valuations of servicing portfolios and so on. And so as we look to this year, and we'll wrap up and conclude with this after we go through the data that we have to present today, but I think the best recommendation that any of us could give would be to just be prepared for multiple outcomes, multiple scenarios. And it looked like until just a week or so ago that interest rates were ticking down, and that inventory was picking up, for sale inventory was picking up. I think the inventory is still trending up, but interest rates are also trending up now, and so that's changed, and so it just changes from day to day. I do think there are some macro things going on that, again, as a non-economist, I will point to, because there's been a lot of discussion about whether there is an oversupply of homes, whether it's actually an affordability problem more than it is a supply problem, and so on. But I think there are at least some factors that are contributing to a supply shortage. And I think, the lock-in effect, which everybody understands already, is certainly one of the things that's impacting for sale inventory. Another that I think doesn't get a lot of airtime is the fact that seniors are aging in place at a much higher rate than they have in the past. And that has a cascading effect down the chain. I think another one is the fact that younger home buyers waited until later years to first enter the housing market and become homeowners, and that delay happened, going back now a number of years, but that's only a one-time delay for all of you accountants on the call. When you think of kind of timing differences, it's just a one-time delay. But once it catches up and they start buying homes, well, now you need homes for all those people that are now buying homes at age 32 that used to buy homes at 26 or 27 or whatever it is. And so you look kind of all throughout the housing supply chain, seniors staying where they are, younger people now very interested in buying homes but having a difficult time finding them because of lock-in effect, seniors staying where they are, not enough homes getting built because so much sand has been ground into the gears for home builders that try to get land and permits and so on. So you just look at a lot of these factors, and I think it is probably safe to say, as a non-economist, that they are factors that would tend to lead to an undersupply of homes. And so that is a factor, but of course we know that affordability is also a factor with interest rates as high as they are and home prices where they are now, which again is circular. I mean, given the lack of supply, tends to increase home prices, and so you just have a number of factors that are leading to a very challenging environment for people, and we all know that. And I probably belabored the point longer than I needed to, but there are some challenges facing everybody right now, and so one of the things that we want to highlight today as we go through the data is now probably more than ever in the mortgage industry, at least going back many years, it's as important as ever to be paying very close attention to the data. And we're going to highlight some things today that some of which will probably not be new to most of you on the call, but some of which I think will probably be new to many of you on the call that haven't done a deep dive into benchmarking data. And it does tell a story. And we're going to highlight some of those trends and some of the storylines from the data. And so I think this is going to be thought-provoking here today, and I think you'll get some benefit out of re-listening to it, getting the slides. Those of you that are participants in Richey May Select, which is our financial benchmarking program, it would be worth spending some significant time in that data, really slicing and dicing and comparing yourself to some of the top performing companies and making sure you identify the areas where there are differences. There certainly are. And so that would be what I would open with and say, pay attention to the data. Now's the time to keep both hands on the wheel and look for any and all ways to operate more efficiently and to be more profitable. And so with that, I want to introduce our presenters today. I think that we've got a good group here. Excited to have the three of us together. I think probably most of you know who these individuals are, but Tyler House leads our financial benchmarking and our data and analytics practice here at the firm, and has been with the firm for a long time. Spent a little bit of time in industry actually doing financial analysis, FP&A work for a mortgage company. Rejoined the firm here a year plus or so ago, and knows this very, very well. Ken Richey, who I'm sure most of you know, or at least know of, founder of Richey May, and a longtime mortgage industry participant, advisor, tax professional, currently leads Richey May Wealth. And he is doing a lot of wealth management, sophisticated tax planning work for individual clients, and is also advising on the buy side and sell side and M&A transactions within the mortgage industry. And so he brings a tremendous amount of experience as he's in the trenches advising clients. So we're glad to have this group together, and appreciate Ken and Tyler taking time. Tyler's going to be probably the primary presenter of the data today, but we're gonna round robin this a little bit and talk about some of these key points that we've identified in the data. And so please go ahead and send questions in if you have them. We will hope to be able to address at least some of them here on the call, but we'll likely run out of time, and but we'll respond to you after the webinar. So with that, I'll hand it over to you, Tyler.
Thanks, Nathan. And, before we jump into our slide deck, we're going to start off with a poll question. As a reminder, you got to answer all 4 poll questions if you want credit for your CPE. But here's the first one. So what's the most significant challenge you're currently facing in trying to address as we look into the year, into 2025 in the mortgage landscape? Got a couple options here. I'll just read them just so we can fill up the time while everyone takes a chance to submit their answers. You're going to want to click on the screen to make your selection, but option A is a lack of refinance volume. Option B is a lack of inventory. Option C would be low gain on sale margins. D would be low profit margins or a lack of profitability. E would be recruiting LOs or losing them to brokers. So here's several options. I'm sure there's maybe even more, but these seem like the big ones from our perspective. And maybe we'll give a few more seconds here just to make sure everyone has a chance to answer this poll question, since we do have this new platform here. But it's pretty slick on the way it is to just answer and submit a question here. So looking forward to the results. Looks like we're almost there. Remember, you got to submit every poll question to get that credit. Got about 70%. So I'm going to move the slide forward. Here we go. Let's see what those results are. Okay, so we got a lot of different things on everyone's mind, and to no surprise, low profit margins is the number one answer, taking a little bit over a third of all the responses. And then it looks like lack of inventory, lack of refinance volume. Both of which probably, are likely contributing to low profit margins, and then low gain on sale and recruiting LOs all come in behind that. But yeah, I think back to Nathan's comments, there's a lot of challenges facing the industry, and there's a lot of things to be concerned about. But good to get this feedback from the group here. And so now let's take a look here. Just to start, today's webinar, we want to focus in on really the major trends in the mortgage landscape. And Nathan mentioned that this data comes from Richey May Select, which is our quarterly financial benchmarking program. In that program, there's about 70 lenders, 70 IMBs across the nation who participate. Lenders from all different sizes will participate in that program. And it's a really good glimpse at the market, at least the IMB market. And then the data that we're going to look at today, it really comes from our retail IMB group. We do have groups that are specific to wholesale or multi-channel. We also have a builder affiliated group or a bank subsidiary group. But the trends today are focused on that retail IMB group, really just to make the trends be highlighted more, and to kind of get some of the different things that can mess with trends from year over year perspective out of there. So retail seems to be that good group to take a look at. For starters, let's take a look at pre-tax net income year over year. So if we look at 2023, it wasn't a pretty year. It was a tough year. The average pre-tax net income was a minus 44 basis points. But if we fast forward to 2024, we see a nice rebound here of 62 basis point improvement. The average was 18 basis points. In fact, 70% of lenders in this retail IMB group were profitable. And so, those are great results. I feel very optimistic about that. And so we wanted to put together a waterfall here just to illustrate, what were the drivers here? What really led to the improvement, and in which categories is driving that improvement. So first, let's start with servicing. So servicing was a 9 basis point improvement here. And in terms of how we come up with that 9 basis points, we're looking at servicing. We're looking at all the activity in the P&L. We're looking at your servicing fee income, your subservicing costs, your servicing personnel costs. If you service in-house, we look at your servicing cost center. And then we're also looking at the MSR adjustment, whether that's amortization or your fair value adjustment, or if you had a gain or loss related to a bulk MSR sale. So that's what fits in that servicing bucket. And in 2024, servicing was 9 basis points better to the P&L or to the bottom line than it was in 2023. And that's really simply, not because of, better performance in the servicing portfolio. It's really just because in 2024, MSR values improved by 9 basis points. And that actually translated to 9 basis points of improvement in the P&L activity, which is great, versus 2023, where that MSR value actually saw a decrease of 15 basis points. So we're getting some help from servicing, which is fantastic and helps that bottom line for 2024. The next category I'd highlight would be secondary gain on sale. So I've got that listed at 20 basis points of help. And really that's a combination of loan size growth. And then also it's margin and BIPs growing, modestly. And when you put those together, we're actually seeing about an $800 increase in secondary revenue per loan. And so if you try to equalize, that change for the, the change in loan size, that's really like a 20 to 25 basis point increase in a year where we don't have, a ton of increase in the average loan size. So that was significant for the year. That was a big lift. Then if we go to the pipeline, lock pipelines were larger at the end of 2024. And so that was a help of 5 basis points in improvement. And then personnel and operating expenses. So I got to admit, actually, here, when we were putting this together, I was a bit surprised. I thought that we'd see a bigger lift, in particular with personnel. I know there's been a lot of staffing optimization efforts undertaken really, at the end, Q4 of 2023, and then in the first quarter of 2024, just to right size to the volume that people are seeing out there. And so we know that those efforts were there, and that those efforts resulted in about a 6% decrease in headcount. Unfortunately, when we look at, the salary change, it's really only a 1 to 2% decrease in salary costs. And that doesn't really seem to add up. You might be asking, how can that be? Well, here's the different components that kind of lead up to that. The first would be most of the staffing optimization was related to sales personnel. And so a large part of sales personnel compensation is going to be commission. And so you're reducing a lot less salary in that personnel group. The other thing is, I think the last 2 years, several companies are, implemented salary increase freezes just with the challenges in the marketplace. And I think in 2024, where we could see, profitability on the horizon, a lot of lenders, discontinued that policy. We also saw, maybe this was a little bit premature, but we did see a little bit of ops hiring during the second half of the year when we were experiencing that 10-week rate rally. So some of that might be premature looking back, but that also is contributing. So if you put these all together, the right sizing efforts, if volume had been the same in 2024 as it was in 2023, those right sizing efforts would have been a 3 basis point improvement to the P&L. So kind of a similar story with operating expense. So if you look at it year over year, operating expenses decreased for this group by about $400,000. That's about a 2% decrease year over year. And so that decrease, again, it helps the P&L by another 3 basis points, again, assuming that volume is flat year over year. And so those are a lot of the different efforts that were made during the year to help out the P&L. And really the rest of it, that last 22 basis points is really driven by an increase in origination volume. So the retail peer group, they originated 17% more volume than they did last year. That would be 11% more loans year over year. And really, I think the big driver here is that after 2 years where we see consecutive decreases of 28% in 23 and 40% in 2022, being able to find the bottom and then see some improvement in origination volume, I think is really the main driver in why we're seeing breaking through that kind of break-even status and hitting that 18 basis point performance. So I think there's a lot of positive trends here. And in fact, this is one of the things I was really curious about is, we see this positive momentum. Again, 70% of lenders had a positive pre-tax net income. But on the other hand, I think, anecdotally, we're hearing of, maybe there's going to be more M&A activity. And maybe, Ken, I'll invite you to address, how can we have both of these elements working at the same time? Usually I think, hey, if there's a good chance of profitability, maybe I'm a lot less likely to want to explore M&A opportunities. But Ken, I'll let you talk to that point real quick.
Thanks, Tyler. Yeah, no, that's a good comment. We have experienced potential sellers that were contemplating making a move to find a partner in the second half of 2023 and for parts of 2024. With these improvements that have come along in 2024, we have seen some sellers slow down that process. They're not as motivated from a financial perspective to look for those economies and efficiencies that might happen with finding a more efficient platform. But there still seems to be a fairly robust, steady activity of both buyers and sellers.
Nice, very interesting. I think one of the other questions I was asking myself too is, I think it's great to see an increase in origination volume, but what does it kind of mean as we're looking at 2025? Were we just rescued by that 10-week rate rally? That was a little bit short-lived, but definitely did have an impact on volume. And so I did a little bit of digging into that too. And so, usually Q4 has got about a 10 to 15% decrease in volume versus Q3. And, if we just kind of put a stab in the dark and say that maybe the Q3 funded volume was 5% higher than it would have been without, the positive rate movement, then I think we actually take that 17% decrease and it's more like a 10% decrease in volume year over year. If we've got a 10%, volume increase, I still think we're positive for the full year of 2024. Obviously, a lot closer to break even, but really the takeaway for me is the industry's moving in a positive direction, in a right direction, and it's really good to see a majority of companies able to be profitable during the year. All right, so that takes us to our next poll question. And I think this is one we're looking forward to hearing what the group on the call has to say about it. We did see that secondary gain on sale was a benefit to most lenders or to the average retail lender last year. But we're really curious to hear what you guys are seeing. So the question is, what have you seen with gain on sale margins over the last 6 months? So 3 options here. They were about the same, so not a significant change in the last 6 months versus the prior. They've improved modestly, or C, the last option, they've gotten worse. This is definitely one that's been important. It's been a big step to help people get profitable. It is one that we don't necessarily have a ton of insight over. We can see the data and we have discussions with a lot of our clients and we hear what's going on there, but will be interesting to see these results. Looks like we got about 65% submitted. Again, you got to submit all these poll questions if you want CPE credit. Looks like we're about 70. So here we go. Let's go check out the answers. Okay. So this looks about right to me. So 2/3 of the audience is saying they're about the same. And then we've got 1/3 or maybe a little less than 1/3 saying that they've improved modestly. And then a small majority say that they've gotten worse. So this is in line with what I think I've seen in 2024, and hopefully this holds throughout 2025 as well, as you got to have good margins to maintain profitability. Okay, so I'm a finance guy, so I love to always look at the forecasts, and this is the MBA's forecast. In the bars, we've got the volume forecast. In the line chart, we see the units forecast. So 2024, 1.8 trillion in volume. If you actually look at the last 18 years, which is what we got on the slide here, that's actually 10th out of the last 18. So it's kind of middle of the road in terms of volume. If you look at the units, though, if you look at the number of loans, we got 5.1 million loans in 2024. And so that actually ranks 17th out of the last 18 years. So we're still very light on units in terms of what we've seen. For 2025, that forecast is a little over 2 trillion here. And so that number would actually be the 6th highest volume we've seen since 2007. So, there's definitely volume out there to be had if this accurate is directionally correct. But in the forecast, we still got 5.7 million loans. And so this is the 4th lowest since 2007. It's better than 24. It's better than 23. But it's only about 300,000 loans better than 2014. And so, that really continues to be the challenge here is the number of units that we're seeing in the industry. I hope the NBA is right in that we continue to see that number grow. But that's definitely the challenge. And we'll encourage you as you're using these forecasts to emphasize the unit forecast over the volume forecast as much as you can. Now, the good news is that as we look at the 2025 forecast, they've got a 16% year over year increase in volume. They've got a 13% year over year increase in loan count. And if we look at Richey May, we have some benchmarking data on production. We've got some real-time benchmarks on application, lock, and funded unit activity. We're actually seeing that Q1 is off to a good start. We're actually outperforming some of these numbers. So if we look at apps through March 26th of this year compared to that same time frame last year, we're actually up 15%. If we look at locks, we're up 20% during that same time period last time. So a lot of indications here that we're ahead of this. And I know that we've had some favorable rate movement in Q1, and hopefully we'll see some favorable rate movements here come back and continue to build those pipelines for the spring and purchase season, as that'll be key to having hitting some of these numbers for the full year. But a lot of good things to note right there. And then,
go ahead, Tyler.
Oh, if you had something, go ahead, Nathan.
No, go ahead.
Okay. So the other trend that I continuously see in the Richey May Select data is that the average loan size just continues to grow. It continues to get larger, and that's one trend that's been very predictable over the last several quarters, is that we continue to see that. And, I think it really talks to some of the challenges that we have in the industry. The volume looks decent, but the units are still light. And it really touches on this housing affordability issue. And so on this chart here in the gray bars, we've got your average funded loan size quarter over quarter. In the blue bars, we've got the median price of existing home sales. And in the green bar, it's your median household income. In the light blue would be the 30-year fixed rate. So average loan sizes in this chart, we see 237 in the beginning. They're now ending on an average of 355K. So that's a 49% increase during this time frame. If we look at income, we see 60K at the beginning, and then at the end of 2023, we see this at 80K. So that's a 31% increase. And then existing home prices, they start at 243K on out, or as a median, and then 408K is where we're ending on this chart. And so that's a 68% increase. And so if you throw a trend line on these, you're starting to see all these metrics continue to spread apart. And I think it really speaks to this challenge. I wish I had the solution to how you fix this. I know a lot of people are have inputs on that, but I'd be interested to hear, from Ken and Nathan, just about this challenge and how lenders might be wanting to think about it. I know you alluded to some of the other challenges, that in the beginning of the webinar about what's making this, specifically very difficult. But how should lenders be thinking about this in the year?
I think, what's interesting is there's kind of a debate around, okay, is it a supply issue or is it an affordability issue? And what I tell people when that debate happens is that it's both. And there's definitely a supply issue. I don't think that can really be questioned. And housing affordability is also an issue. And this trend, or this graph shows it. If you were to draw trend lines there, it would show that median incomes have not kept up with median home prices, and interest rates, as they increase over the last couple of years, has made it increasingly difficult for people to qualify, particularly first-time home buyers. And as the lock-in effect, seniors aging in place, everything else that leads to the undersupply of for sale inventory, makes it very difficult for them to get into the housing market, buy a home at the current cost of a home and the current interest rates, without money coming from the mom or dad or grandma or grandpa. And so it's a very challenging market for them. And so I while I don't know that I have great recommendations for anybody other than to say, probably just expect 2025 to look not too much different than 2024, and next year might not be all that different either. The MBA forecast shows a little bit of an increase in volume each year, but who knows? There could be something policy wise or something that happens to drive interest rates down. Maybe a recession hits this year. They're at least reasonable. There's a reasonable chance of that, according to economists. So there's any host of things that might change it, but I don't know that I would adjust strategy based on what is expected to happen this year or not.
Yeah, a lot of challenges, and hopefully we'll see these trends at least turn or stop becoming less favorable. It would be great to see that. I know everyone would find that as a major benefit. If we move on to the next slide here, another trend I wanted to highlight that we're seeing really across the board is a few shifts in servicing. So in 2024, we can see that there's been a bit of a more significant shift in servicing among our client base than maybe we've seen in past years. In the gray area on this chart here, this is just the percent of lenders that had a servicing portfolio of over 100 million at the end of each period. And so if you look at 2016 through 2019, that was in maybe the high 50s or low 60s as a percent. And then during COVID, that number spiked up as a lot of lenders began retaining servicing then. And then we've seen maybe a steady decrease until you get to 2024, where that number dips below 70%, which is the first time we've seen that number dip below 70% since 2022. The other thing I want to highlight in here is that this blue line, this is your MSR UPB as a ratio to annual origination volume. So if you're $1 billion originator, you'd have a 0.5 ratio if they had an MSR UPB of 500 million. And this was kind of where most of our lenders were in this retail peer group until 2020. We can see that grow as retention rates began to grow. And then in 2022, as volume started to decline, this number spikes up, and it's been over 2 since 2022, and being over 2 has been beneficial to lenders, especially as volume goes away. It's helped offset some of the losses that they would see in origination. But now we're starting to see that this trend is now below 2 for the first time since 2022. It does seem like there's a bit of a shift going on here, and there can be, I think, a number of things driving the shift. Nathan, do you have any thoughts on how we should interpret these results and what might be the driving force behind these changes?
We actually have a slide coming up here where the data will support some of the comments I want to make about this slide. So for now, I'd say for everybody that's on the webinar, just capture this slide as a mental image that we can refer back to here in a few slides when we dig into the actual data, and analyze the differences between the top performing group of retail originators and the rest. And so just anchor this one in your mind, and we'll talk about it here in a few minutes.
Yeah, we'll get to it in a few minutes, but first, another poll question. So this is poll question number 3. It's focused on your MSR servicing strategy for 2025. Again, not to sound like a broken record, but I just want to make sure if you want CPE, you answer this question. You got to answer all 4. We'll have one more following this. But the question is, what changes do you anticipate in your MSR servicing strategy for 2025? We've got several options here. Number A, we plan to retain more MSRs in 2025 than we did in 24. B, we plan to retain fewer MSRs. C, we have no changes to our MSR strategy. D, we plan to sell all or a significant portion of the MSRs. Or E, not applicable, or I'm unsure. If you don't retain servicing, I suggest let's input item E here. But it looks like we're at to that 70% number. So here we go. Let's go take a look at the results. Okay. Interesting mix here. So about 20% of the lenders of the attendees, are unsure or aren't servicing. But outside of that, if we pull that 20% out, it looks like 60% are saying, hey, we're having no changes to our MSR strategy. A small percentage, it's at 5% plan to sell a significant portion of the MSRs. And then the rest of it is split between, hey, we're going to retain a few more, or we're going to retain, less MSRs in 2025. That's good insight to hear. Okay. So those are kind of the big level or the high level trends that we wanted to talk about that we've observed, really across the board among our participants in Richey May Select. And now we want to shift gears a little bit. And again, this is a topic that we do cover quite a bit. We're focused on it. The reason we're focused on it is because we want to help our clients, become top performers in the industry. I think the last few years have really illustrated that it's important for lenders to be, performing well, to be, very efficient, for the long term if you want to stay in this industry. And so that's what the remainder of the section or of the slides will be focused on this top performer. And with that, let's go to our first slide here in this category. And so the first question you might ask is, okay, what do you guys mean by a top performer? And so here's how we define it inside the program. We're just looking at the top 25% of lenders based on pre-tax net income. And we're looking at the top 25% in basis points and in dollars per funded loan. So it's not thousands of dollars. If you did thousands of dollars, what you would end up seeing is that, a lot of the top performers skew towards the larger lenders. So we look at it this way, so we can glean the insights of what makes a top performer from a profitability standpoint of basis points or dollars per funded loan, really at any size. And so here's a couple measures I want to highlight before we get into some of the other results. Pre-tax net income. So this is essentially going to be like your GAAP net income. This is what we base it off of. But if you look at the average, and this is similar to what the waterfall showed, the average was 18 basis points. And so that's what we're showing here. But there's quite a significant gap between the average and between the top lenders. So we're talking about 18 versus 75 basis points. It's a 57 basis point difference between the top and the average. And then if you look at it on a dollars per loan perspective, we're talking about $1,800 per funded loan. So pre-tax net income, we'll talk about that throughout, and that's obviously an important measure for this. Pre-tax, again, is going to include all of your activity. It would include servicing and origination. It would include any other business activity that you might have as well that's not specific to origination or servicing. Then the other measure I want to highlight is net production income. So net production income is going to be different in the sense that we're really trying to isolate your origination platform profitability. So for that, it's for most IMBs, that's pretty close to the entire P&L, with the exception of we're pulling servicing out of that. And we're also pulling the gain or loss tied to the lock pipeline. On an annual basis, that number isn't usually a really significant number unless we see a significant change year over year in production. But we do pull that out because on a quarterly basis, we do see more significant changes. And so the other thing I want to highlight, and again, we'll encourage everyone to take note of these numbers, is that the top performers are not just, top performers in terms of their pre-tax net income. There's also a pretty significant gap in their net production income as well. So the top performers, they're at 19 basis points versus a 10 basis point loss. So it's about a 30 basis point difference, between those groups. And then on a dollars per loan basis, it's almost nearly $1,000 per loan. So we're seeing both with among the top performers that both in net production income and pre-tax income that they're outperforming.
And Tyler, before we jump to the next slide, I just want to point out here, and we're going to say some things here on the call. We're going to challenge some of the, I think, widely held notions and beliefs in the industry, some of the things that we hear repeatedly in terms of, what we'll say maybe debunk some of the myths out there as to what leads the top performers to perform better than the others. And I think what we'll see here is that it's not some of the things that people often point to. So we'll kind of say some of the hard truths here on the call, but I want to point out, when you look at the 75 basis points the top performers made last year, by all accounts, 75 basis points in a year is a really good year. And even historically, when you go back to the 20 teens, 75 basis points would have been a really solid year in any of those years for a retail lender. So, they are doing things that are just better. And we want to highlight some of those here because, as Tyler said, we want to help our clients get into that group and perform better. And there's some things that just jump off the page as we go through this.
Yeah, Nathan, you alluded to like kind of trying to talk through some of the different things, because I think a lot of times the temptation is to look at these top performers group, and if you're not in that ballpark, I think the temptation is to say, hey, I think it's just because of X, Y, and Z, and that's why these are top performers. And the tricky thing about that is usually there's a little bit of truth to that, but it's usually not the whole story. And I think in particular in 2024, who the top performers really help illustrate some of those things. So we're just going to go through a couple of the things here. We've listed a lot of the different kind of markers of what we generally think of as items that might impact profitability. And so we're going to go through this. And the first one I hear a lot is size, right? Size. It's only the largest lenders who are the top performers. They have these economies of scale, and so they're able to spread out those costs, over a much larger, origination base, and that allows them to either have better pricing and capture more market, or it allows them to just have a much lower cost and send the cost savings straight to the bottom line. And so what we see here is, if we look at the average, the top retail, they're at $2 billion, and the average is at $2 billion. They're remarkably close, so almost indistinguishable in terms of the origination volume that they're doing. So that's one. The other might be servicing, right? And in particular, in the last few years, when servicing has been really important to the bottom line, I think you might go to this one a lot. It's only the lenders who have large servicing portfolios that are the top performers. And so again, I think that there is some truth to that. But if we go to the right-hand side of this slide and we look at the average servicing portfolio volume as of 12/31/2024, the top performers are at 5.3 billion, and the average at 4.5. So yes, the top performers have a larger portfolio, but it's not, materially larger that I would expect it to drive the results that we were seeing in pre-tax net income. You might also look at, the other thing I would like to point out is, if you go a few lines down to the percent of lenders with servicing, you'll notice in the top retail group, not everyone is servicing. There's 30% of the lenders in that group who don't have a servicing portfolio. And so they're not subsidizing their origination platform with servicing. They're actually in the top performers group because their origination platform is profitable. Now, the top performers, they have more lenders who are servicing. There's a 10% difference there, but it doesn't really make the day. The other thing you might want to look at when it comes to servicing is the MSR UPB to origination volume. So this is what we flashed on the screen a few slides ago about just looking at that relationship. And again, the top retail, they have more, right? They've got 2 times the MSR UPB to their annual volume, but the average group is still averaging 1.8. So not a major difference in regards to the servicing piece of it, although it does play a part.
And Tyler, I want to point out another one that I'll often hear, a myth that can be debunked here is that people will say, well, they have a higher Govy mix because Govies have a higher margin, and that's just not the case. As you can see, they actually have a lower Govy mix of their production. And so as you look at this slide here, there's some things that do jump off the page, right? Those are myths that can be debunked, but there are things that do jump off the page. And Tyler, I think you're probably going to get into some of this in more detail, but production count is one of them. They're doing roughly the same volume but lower count. If you go down to jumbo, they're doing fewer jumbos. So they're doing fewer jumbos and fewer high balance loans. Look at the geographical dispersion of the loan production, and you see the top performers are doing more volume in the Midwest. Northeast is about the same. Southeast, I mean, those differences are insignificant, but they're doing a fair amount less volume in the West, which obviously would explain the fact that they have fewer high balance loans everybody already knows that California and the other Western states, because of the price of the homes and the size of the loan amounts, it's just a more competitive market. And so, the borrower's a little bit more finicky, more discerning. They're gonna get multiple offers. They're gonna shop you. You're gonna end up giving more concessions, and so the business it originated at a lower margin in the West than it is in the Midwest. And so you see that jump off the page. The aggregator percentage is different. They are selling more of the agencies. That bears out on the right side of that slide in terms of servicing. They do have more servicing, but again, as Tyler said, it's not dramatically more servicing. And so you look at some of these other trends, and these are the things, and along with what we see here on the next slide, that are contributing to the difference. And it really doesn't have anything to do with volume. It doesn't have anything to do with the amount of servicing, and it doesn't have anything to do with Govy conventional mix. There are other factors at play.
Yeah, and Nathan, before we move on to the next one, I just want to iterate too. We're not saying that you should do less Govy. We're not saying that you shouldn't have a servicing portfolio. We're really just saying that a lot of those markers, which actually can be strategies to help profitability, they are not the only drivers here or the only difference here. We see a lot more nuances going on. So let's take a look at some of those other.
And Ken, I want to have Ken jump in here real quick, Tyler, with the M&A lens. Ken, I know it's been a trend now for a little while that buyers, some of the known buyers out there, are particularly interested in the Midwest, right? And are you still seeing that?
Yeah, absolutely. I was just going to mention that most definitely, that's where the perceived better margins are, and some of the larger lenders that are proven and quality M&A players are specifically targeting Midwest and Southeastern type of markets, especially if they're not strong there already. They do bring a premium.
Yeah.
Good stuff. Now, I guess we only got 13 minutes, so hopefully we can get through this and not leave anything off the table here. But I'll jump right in. There are some changes that we see to the top performers. So year in and year out, we do look and try to understand who the top performers are, and sometimes there are some measures that do change a little bit. This measure, variable profit margin, though, is one that we see as a marker of the top performer group. Year in, year out, every quarter, this tends to be a marker of who's being profitable in that current marketplace. And so by variable profit margin, really, we just simply mean it's your total production revenue less your sales compensation, and that's what we're defining as variable profit margin. You might have other things that you want to look at internally. You might want to look at marketing spend or other technology spend that's direct and variable as part of this. But for simplicity's sake, we're just looking at it from this lens. So this really illustrates something very interesting when we look at the basis points and the dollars per loan. A lot of times I think we lean towards looking at our performance in basis points. I know that's the language of the industry, but when we look at this in basis points, we're going to notice that there's a variable profit difference. But if we look at the total sales comp, it's very close. And then we look at total production revenue, and it looks like that's really the difference between top performers and the average group. But then if we move over to dollars per funded loan, we get a little bit of a different story. Variable profit is there's still a gap there of almost $400 per loan. But then it looks like that revenue is equal, and that's not the issue, but it's actually sales compensation. And so I think this illustrates a good point. This is kind of my soapbox. Whenever you're looking at a P&L, I think it's a best practice to look at things on a dollars per loan basis. I know not everything in the P&L is driven by units, but I think that's a good practice to look at things. And maybe I'll invite Ken and Nathan to jump in here to talk about a few other observations that they notice on this page as well.
Yeah, that's a good point, Tyler. It's always important to look at both, right? Basis points and dollars per funded loan, because each of them does tell a different story. We'll see this as we go on to the other slides as well. I'll keep my comments pretty short because we do have some other slides we want to dive into here. But the top line number there, gain on sale, the difference between those two columns, BIPs, dollars per funded loan, is entirely chalked up to the loan amount, right? The loan size. And again, that goes back to the geography of where they're originating loans. So as Tyler said, we don't want to necessarily tell you what loans to do, whether to do more or less govies, or where to lend. But maybe I'll say with a wink, originate more loans in places where your people aren't going to get beat up over the rate all the time, and where you can actually get a reasonable margin, because the majority of the difference in performance between the top performers and the rest is in secondary gain on sale. And so they just have better margins. And we're also going to see that it translates to slightly higher servicing values. And I would say that's another one of those circular items where you say, okay, well, they're originating loans that have a higher weighted average coupon. Therefore, it's going to have a higher servicing value. And so it's like all the way along, from origination on through servicing, you're just originating a more valuable loan where you're getting less pressure on the margin. You're able to hold that margin, and the top performers do that. They pay attention to the geography, and then they also are really slicing and dicing the data. And I'll put in a little shameless plug here. I guess I wasn't planning on this, but if you're not looking at this stuff on a granular level, really detailed level by geography, by loan officer, by branch, and looking at all your secondary gain on sale, looking at productivity metrics of all of your different loan officers and processors and underwriters, if you don't have a business intelligence platform that allows you to do that, give us a call. We really try to marry up the financial benchmarking data that we have and can provide to clients with a business intelligence platform that allows them to really get granular into this, where you can identify where these issues are coming from. So little shameless plug there, but yeah, Tyler, just to put a point on there, that secondary gain on sale is where it's at. It's all in sales. It always has been and always will be. Yeah.
Just a quick comment, Nathan, on this slide. When buyers and sellers are looking at a potential asset transaction, this data is critical because a seller has no interest in moving their production team to a company with a less efficient variable profit margin. The numbers never work if they do that. So they're seeking data about who the buyers are and are they more efficient or aren't they?
Yeah. And one other comment that I'll make here on this, again, saying maybe the tough thing that needs to be said, and we'll be subject to this ourselves as a service provider to mortgage companies. You'll see a lot of them, whether it's with us or with others, that are beating up vendors and contracts and things to get that extra, $1,000, couple $1,000 or whatever. And it's like, yeah, that might translate to a BIP. But that is a case of stepping over dollars to pick up pennies. And it's just focusing on the wrong things. And so don't spend the majority of your time focusing on the pennies, focus on the dollars. And because there are things that are much, much more significant contributors to this difference between these two groups than those items. That's just one other thing I'll mention.
Yeah, all really good stuff. It really takes us actually to our next poll question and our last poll question. We're mixing it up here a little bit, so a little less business, a little bit more fun. I guess March Madness is underway, and hopefully your brackets aren't busted yet. But the question is here: a recent survey from Action Network found that average employee loses 2.5 hours of productivity per day during March Madness. How much does this cost the U.S. or U.S. businesses as a whole? So again, there's no right answers. If you don't get the right answer, don't worry. Your CPE credit's not in jeopardy, but you do need to submit one. So we'll let you answer that. And while you do, I think one of the other things I'll mention is, Nathan talked about focusing on those areas where there's opportunity for improvement. I think there's a couple items on variable profit that do present as opportunities, and opportunities where the top performers, are beating the average outside of margin. And one of those is going to be origination direct costs, right? They're marginally, they're a little bit better there. And then the other one would be net warehouse spread. So those are two areas where, there's opportunity there as well to make some improvement. And we see those, the top performers being more efficient there. All right. It looks like we've got plenty of responses. I won't spend too much time on here. And the correct answer, if you're curious, is 10 to 20 billion. That's what the estimate is. Who knows how good those estimates are? But whatever it is, it's a big dollar amount. But in the interest of time, let's keep this going. And on the topic of productivity, here's another good chart when it comes to looking at your performance as a top performer versus the average. So on this left-hand side, we are looking at loans per FTE. And so these are monthly averages. If we look at this total sales
Tyler,
personnel.
Sorry to interrupt you. We were coming up on time, and I recognize that. For any of you that have to jump off, go ahead. You'll get the CPE credit. You've already answered the 4 questions. And so if you have to jump off, go ahead. What Tyler and Ken and I will do is we'll finish the presentation as if all of you were still sitting there, even if we're just talking into the wind. And that way, when we send out the recording, you'll get it, because there are some more valuable insights that we have to share here over the remaining few slides. So if you do have to jump off, wait for the recording and then just pick up here where you jump off, and we'll finish it as if you were here. So just wanted to throw that out there. So go ahead, Tyler.
Yeah, sounds great. So as I was saying, for total sales personnel, the top retail, right, they're averaging 2.4 funded loans per FTE. And that's a monthly number. So that's out of all of their sales FTEs, they all average that number versus 2 for the peer group. So obviously productivity is important. And that's another marker that we can see. In total, the top performers are at 1.3 units versus 1.1. That's 11% better than the average. And then on the right-hand side of this chart, we're looking at the costs here. And so, Nathan, maybe I'll just pause real quick and let you and Ken highlight a few of the observations that you might see on this chart, maybe a few areas where people might want to focus their attention.
Yeah, thanks, Tyler. I'll jump in first. Ken, you feel free to jump in anytime. I think what jumps out at you is you see a lot of them are very similar, but there are a couple of them that are different. They're definitely more productive in their sales ranks. And so when I made the comment a few minutes ago about the fact that it's always sales, it always has been, it always will be, and it's how well do you preserve the margin, and are you trimming the ranks of the sales team and removing the non-performers or underperformers that aren't doing sufficient volume to justify their continuing employment as loan officers. And are you getting rid of LOAs, because not very many people need LOAs these days. And so if you can manage the sales ranks as a real sales org, because at the end of the day, mortgage companies really are just sales orgs, but they need to be managed like sales orgs. So if you focus on making sure that you've got producers that actually produce, then that number is going to improve. You'll have more loans per salesperson, including LOs and any support folks. The other one that jumps off the page there, and that wraps in the sales support item there, they just have fewer, they have fewer LOAs. They don't have as many, regionals and branch managers that are getting overrides and so on. And then if you go down processing, they're much better on processing. Underwriting, they're actually a little worse. And so it's not in underwriting, it's not in closing, post-closing and ops, they're slightly better, but that's not too significant. But processing is pretty significant. They're a lot better in processing. So they're obviously deriving some efficiencies there and are able to do more loans per processor. And so that's an area that definitely should be focused on. You should be looking for ways to improve that processing throughput. Some of that could also, again, all these things are kind of circular or tie back to the same thing. I think that one actually does have something to do with the loans that originated. A high balance loan, you're going to be dealing with a higher net worth individual. And so there's just going to be a lot more involved in that loan file. And so the file itself is going to be more complex and take more time. So that one could also just be a product of the geography and the average loan amount. So I think that one is probably a significant contributor there to the processing as well. But they also are paying attention to those processor productivity metrics and productivity metrics in other areas. And then you get into the corporate personnel and overhead items, and there's not any real significant differences there that are at least enough to call out. Human resources, not sure how I would explain that one, other than for some reason they're a little leaner in human resources, but not sure why. Ken, any others that you would call out here?
Well, just anecdotally, when I talk to some of the top performing entities that seem to have a little more budget for things that for example, a CEO wants to spend money on, I've heard the following comment from some of those types. There's only two things I don't budget for. One is marketing, and the other one is technology. Meaning, they're going to intentionally be aggressive, trying to improve themselves in those two areas.
Yeah, and what's interesting here, and we'll see this on the next slide, but you can see here that that's the case in both IT and marketing. They're less efficient there, but when we get to the next slide and we look at operating expenses, they're actually spending less on technology. So if you go down there, fourth item down, equipment technology, they're spending less. So they're spending the money on their IT teams, and they're hiring good IT professionals, and making sure that those IT professionals do a good job for them. But they are not the type of company that are out there buying every new shiny object off the shelf that becomes available. So they are much more disciplined about the technology investments they make. They are not shiny object buyers. And I would tell you, as an advisor and friend to many of you, I would caution everybody to be careful with technology investments, because there are a lot of them that have not gone very well over the last several years. I think there are a lot of promises made by technology companies that don't actually materialize. And so, yeah, Ken, to your point, they do focus on hiring good IT folks, but they're not necessarily just buying every shiny object. They're relying on those IT folks to create efficiencies without buying, just stuff off the shelf that doesn't really pan out.
Yeah, and on some of the larger ones, Nathan, in alignment with that, what we've seen on the acquisition side, when an acquirer goes to acquire a smaller company, they spend a fair amount of time letting them know that their internal IT people are building tools which drive leads and help expand and grow those divisions that they're trying to acquire by building those tools internally with their IT teams.
Yeah, I think that's absolutely spot on. I hear the same thing. And good IT professionals, just like good accountants, are worth their weight in gold. And you get good IT people, and if they're staffed with creating efficiencies, mining data, serving up data for for the company, for its leaders, for the loan officers, sales leadership. Those people are worth their weight in gold.
Hey, Nathan, I got to make one more point on this last slide, and then I'll hand it, to you to wrap up here. But I just wanted to touch on this personnel productivity slide. And I wanted to mention one thing, I think it's really important that you look at these metrics together as a whole and not individually. If you're looking at this personnel productivity, you might look at this and share this with your sales team and say, hey, we need to be more productive from us, as a sales organization. We need to find out how to get more units out of our loan officers and out of our sales support and out of our sales management. And I can almost guarantee that 9 times out of 10, their response is going to be, well, get us better pricing, right? And we'll take care of that right away. But the other side of this is that the top performers also have, higher variable profit. So it's not that they're just doing more units because they have better pricing. It's because they're more efficient at selling their rate sheet, and they're doing more units that way. They're not wasting money on excess resources or anything that's not productive. And so I just want to make sure that comment gets heard, because if you're sharing this deck out with your team, just make sure you share all the pages and don't camp on any one of these. But with that,
Tyler,
maybe let's
if you'd go back to slide 16, I do want to make a point on that slide as well, as far as a takeaway and another myth that can be debunked. You shared this when you showed the roll forward on 2023 to 2024 and the things that contributed to that increased profitability. But then, if you go to the slide 16.
Okay, so not this one, but
go ahead. A few more there to the first top performers. Yeah, right here. So another one of the things that people will often say is, well, the top performing companies are just getting it in servicing, right? They've got more servicing and they're valuing it higher, and they're using some crazy high, they're using some crazy high multiple to value their servicing. And as you can see on this slide, that's just not the case. On the right side, the MSR portfolio value, the difference between the two is only 6 basis points. And again, to the point that I made earlier, that is probably entirely chalked up to the loans they're originating. They're originating loans with a higher weighted average coupon. They're going to have a higher value placed on them, slower prepayment speeds because they're not in California, Oregon, Washington. Colorado is now a very high cost state as well. So they have slower prepayment speeds, higher WAC, and they're going to have a higher value placed on that servicing. So, but if you look at the difference in performance on gain on sale alone, it was 30 basis points. So the servicing value, that initial capitalized value, if they retain the servicing or the portion that would be kind of the SRP if you're selling release, the aggregators, that difference is only 6 basis points of the 30. And so that myth that is commonly floated out there is also not accurate. So the gain on sale does not have a whole lot to do with differences in the marks that are used by the top performers versus the rest. And like I said, I think that 6 basis points is entirely chalked up to the better loans at a higher WAC and slower prepayment speeds that they're originating, not because they're playing games with the servicing valuation to get GAAP earnings, because a good portion of these companies that are in Richey May Select are also audit clients of ours, and so we wouldn't allow them to play games with it anyways and shift all over the place depending on, interest rate movements and so on in that range of valuations they're provided by the servicing valuation firm. So the numbers there are accurate. It's only 6 of the 30 basis points, and so they're getting better margins, period. And so that's another point that I wanted to make there before we go on to wrap this up, Tyler. So in terms of takeaways or recommendations we might have, we've highlighted some of them here and during the presentation, but just to summarize some of them here, do what the top performers do. And the top performers are very focused on data. They are constantly analyzing data. They're the ones that come back to us with the most questions. They, following the production of the quarterly benchmarking results, they're the ones that are digging into it and asking us to dig into and give them answers. And they're picking this stuff apart. So that would be one, because you can't do a lot of this stuff if you don't have the data available to you. But they obviously have better variable profit margins, as Tyler pointed out. So focus there. And a big contributor to that, as we saw on that slide, was gain on sale margins. So focus on gain on sale margins, focus less on the $1,000 here or there or whatever. Focus on gain on sale margins and where you have to originate loans to ensure that you can keep the gain on sale margin, and make sure your loan officers are selling the rate sheet. And I skipped over one there, but selling the rate sheet and not granting as many concessions. The top performing companies, and this is always the case, just grant fewer exceptions. They hold the line with their loan officers. And if the loan officer can't sell the rate, then they're coaching them or moving them out. And they're just not going to allow a loan officer to continue to grant concessions over and over and over again. So just don't allow it. Plant your feet. Right size the sales organization. Get rid of the loan officers that can't sell the rate and aren't doing enough volume to justify their continued employment with the company. Pay attention to the productivity metrics. We highlighted some where there are differences. And so pay attention to those productivity metrics. And then geographics, along with my wink about where to originate those loans. Originating loans in the West is just more challenging. And so you have to know that going in, and you may have very legitimate reasons strategically for doing business and wanting to do more business in the West, but you have to understand that it does come at a cost. And that cost is the difference between making pretty good money last year and just kind of doing a little bit better than break even. Or if you look at it on net production income basis, losing money as opposed to making money. And so that's a big one. So pay attention to the geography, make sure you're analyzing all of your loan production, looking at all that data, and benchmark your performance and act on it. Don't just get the reports, take a quick cursory review and toss them aside. There are things that you can see in the data that emerge every quarter that are maybe new, they're different. And so there's some of them that just remain consistent month to month, quarter to quarter, and year after year. But there are things that'll be little nuanced differences that you can pick out as you look at the data. So pay attention, look at the data, spend time with it, and then act on it, do something about it. And if we can help, we're always here available. You reach out anytime, you call any of us, send an email. And we'll jump on and dig in and help where we can. But as Tyler said, we feel it's our responsibility to shed light on some of this stuff and help our clients operate better and be more profitable. And that's really our goal. So if we can do that, please reach out. And we thank you all again for joining the webinar today and taking the time. We're sorry we ran over. But we did record it, so we'll send it out to everybody. You'll get it. And if you missed some of this, hopefully you'll get some benefit by listening to it here in the coming days. So thanks again, everybody. Have a great rest of your day, and we'll see you all soon. Take care.